Anyways, hi everyone. My name is Kendra Rommel. I am a co-founder of a company called Futures Financial. We are a private money lender. Also previously, I feel like we should start saying previously known as a hard money lender, but somewhere that got weird, so we changed it. But we specialize in bridge, value add, ground up construction, and a long-term stabilized product that's been kind of smeared through all marketing material known as DSCR. Our asset classes that we specialize in are residential and I'll call it low balance or the underserved multifamily market. We are a California-based company. Our office is located in Orange County, California. And we are a nationwide lender. We tend to stick to the non-judicial foreclosure states for reasons that any asset manager would know. And then as far as how we're capitalized, we are backed by a family office. We have funds backed by that family office that have Reg D exemptions attached to them. We also have our own balance sheet and friends and family money, as well as some strategic partnerships with institutions. So
for every bull, there's a bear. Bill, would you mind introducing yourself?
Growl. Kendra and I have known each other a long time, worked in the same industry, and then diverted in different directions. My name is Bill Bymel. I am a seasoned whole-loan investor. I founded First Lien Capital 3 years ago. We don't originate mortgages. We buy existing most often other people's mistakes. We're more often than not buying non-performing, sub-performing loans. In the residential market, I've been doing that for 15 years. I started this company 3 years ago with some of my own money and some partners and friends and family. We have Wall Street partners that we joint venture with, but we do have an ongoing friends and family fund that's kind of our permanent equity that goes alongside every deal. We play mostly in the default space, or we buy from sponsors that are having trouble and need liquidity.
Very good. Thank you for that. Kevin.
Sure. I'm Kevin Arrabaca with SDC Capital. SDC Capital is really more of a family office, a real estate family office. We have roots in development dating back several decades. Today, we are largely a multifamily operator, owner, mostly in California, where we manage all those properties in-house, and also primarily in two out-of-state locations, where we outsource that property management for over a couple thousand units. We also have a private lending business and alternative credit. We specialize in multifamily. It's something we're good at. We own it. We understand how to value it. And also residential property, simply because it's easy to value. And we'll also focus on other property types, but maybe largely stick to the major food groups. In terms of our capital, we fund our own capital into the deals we invest into, along with a handful of investors. I'd say for the last 400 million in deals that we've done, about 120 million of that has been our own capital, and in many cases subordinate to our investors. So we try to align ourselves with our investors and what we're doing. We stick to primarily California, to markets that we think will have property that is relatively easy to value, easy to sell if we had to take it back. And we have boots on the ground in several Southern California locations. And then up north, we have lending partners that we support as more of a capital source.
Good. And then that cleanup, Brock.
Brock Vandenberg. I run Talamar Financial. I'm also the fund manager of Talamar One. It's a $250 million mortgage fund specialized in funding short-term debt for residential and commercial, either fix and flip loans, bridge loans, or construction loans here in Southern California. We've funded over 450 million. Fund is primarily made up of high net worth investors and family offices. In fact, I think we just eclipsed 300 individual investors in the mortgage fund. Yeah, and that gives you a little background on who we are.
Appreciate it, everyone. So I think Bert was a pretty good opening for us earlier today about a little, some of the doom and gloom that's in the marketplace out there. So every time I open up the Wall Street Journal, go on LinkedIn, any media type thing, it's office, toxic, hospitality, toxic, multifamily is crashing, all these syndicators going up in smoke, SFRs overpriced across the board, crack showing in the job market. AI is going to take over the world. Did NVIDIA beat earnings? I mean, that's probably everyone on top of everyone's hit this every quarter. But with all the negative, I think there are some opportunities out there. And I want to ask everyone in the group, what tailwinds do you see coming down the pipe that are helping you guys out? I mean, Bill, I think you're on the other side of the spectrum. On our planning call, you had said, you know, I've been waiting for today. What do you mean by that? Will you bet lead off on this?
Yeah, I'm the last when I founded this company, I thought I was kind of getting out of the business. I wrote a book in 2017. I was like going to move to LA and go into film. That was going to be my thing. And then COVID hit, and I said, well, there's going to be a distortion in financial markets that would cause huge opportunity because we play in the secondary markets. We play with big boy Wall Street guys who know us as liquidity providers in small dollar numbers, anywhere from 5 to 15 to 50 million at a time. And so when COVID first hit, it was right when we were getting things started, and we were expecting a huge array of default. And obviously the government intervention put a halt to all of that. Well, the long run of low interest rates and then the sharp increase from 0 to 5 that we've seen, that move from a financial, mathematical, and exponential level it pales in comparison to anything that we've ever done before. And the markets are just now starting to realize that. And I'm experiencing that by way of seeing opportunities really start to open up for us. People coming to us, sponsors that are having trouble with the higher cost of capital and needing bailouts. We're seeing a rise of defaults, obviously a huge amount of commercial opportunities. It's starting in the major metros, but I think it'll work its way systemically across the nation. So it's, it took a few years for it to happen. And we ensured it would happen by dropping several $1 trillion of new capital into the markets and leaving rates where they were for too long. And now, the chickens will come home to roost. We're kind of just waiting for, it's kind of all just happening now. And so I'm seeing a lot of, 10x the amount of opportunity coming on the sidelines, every day.
So now on the opposite side of the spectrum, on the origination, what tailwinds are you seeing, Kevin, come down the pipe? Where are you seeing the opportunities for your firm?
Sure. So kind of what Bill is mentioning, I mean, our applications are up over 300% year over year. And I think that is largely just this disruption in the debt markets. And really the banks have looming concerns of capital requirements. There's the that's coming along. That could be both a positive and negative, but what's causing a lot of borrowers to be more hesitant in going to the banks and really considering private money as an alternative. So there's been a greater acceptance and awareness of private money, hard money. Hard money used to be a bad word. Now it's becoming a much more common thing and accepted among transactions. And with that, we've seen an abundance of opportunity. A lot of the bank deals that would typically go to a bank a couple of years ago, we're seeing the increase in the quality of the deals that we're seeing today, given the constriction in the bank lending. And as Bill alluded to, kind of the increase in the rates, I mean, we've seen a convergence, in the private lending side, we don't really move, our pricing doesn't move with the ebbs and flows of every market move in the bank prime rate, but as the bank prime rate is adjusted, say 5% of the last couple of years, we've seen a convergence of our pricing with bank pricing and becoming much more competitive. And with that also is really the competitiveness of our deals, where we're not always having to win on price. I think given the chaos in the debt markets, I think that a lot of our customers or borrowers and brokers who are bringing us deals, they're really thinking about elements such as certainty of closing. Can they get the deal done? Are they going to be able to get to the finish line? That's becoming much, much more important than getting left at the sideline at the last minute and not being able to get their deal done. Those are some of the tailwinds we're seeing.
How about yourself, Brock?
Yeah, I think Kevin brought up a couple good points. I think, our lending primarily here is in Southern California, and we're still suffering from a supply demand imbalance. They just don't build enough housing in Southern California. So we continue to ride that wave, provide the financing. Our clients need to either, rehab single family, multifamily properties or buying commercial properties. You just you see that as a headwind or a tailwind. The other thing that you're seeing from a banking perspective is you're seeing a shift within banks, especially small and regional banks, away from actually lending to individual borrowers and lending to debt funds like ourselves. It's much easier for them to lend into debt funds than it is to go out and originate their own loans, which is why you're seeing a significant increase in capital shifting away from, our borrowers going and getting the ability to get financing from traditional banks where they used to. Kevin brings up another good point of, the quality of borrower that we're seeing has increased substantially.
Can you just clarify what it means lending to your fund? Are they giving you warehouse lines?
So warehouse lines,
Okay.
credit lines. And so, from a bank perspective, it's a much safer bet. Your loan to value ratios are typically a little better when you're lending in to a debt fund. You don't have to go out and originate your own loans. It's a pretty simple transaction. So, and you're seeing a significant increase, especially in the last, say, 36 months, to banks lending to debt funds like ourselves.
So your fund has how much assets under management?
A little under 100 million.
And then you have nominal warehouse line from the bank additional.
Yeah, we've up to 10 million.
Okay.
Yeah. And honestly, I get calls all day long from banks wanting to give us the higher credit lines. It's just the demand that we don't have the need for that much credit.
And it's what we have seen over the past years as well. I've said leverage cuts both ways. So borrowers taking on too much leverage as well as lenders. So it's something as a passive investor considering investing in a fund that is utilizing some sort of leverage. You may want to know what that leverage component looks like.
What rate should you expect on hard money these days?
So rates, it depends. It's really property specific and also regional specific. So if you're in Southern California, you're probably in the mid-10s. If you're in the Midwest, Northeast, you
I'll
can
let Kendra touch on that. So Kendra, would you mind elaborating on some of the
Brock, you're saved.
opportunities? So Kendra, this panel is unique that we have, so asset-based lending, hard money, private money, alternative money, it's all kind of used interchangeably. So you're gonna hear all these terms for you listening in. But Kendra, would you mind sharing where you're seeing the opportunities? Because you have exposure to markets across the country where the remainder of us up here are more California focused.
Yeah, I don't want to, there's no point or time for redundancies. A lot of what Bill touched on, I 100% support and agree with in terms of just paper movement. And from origination, both of the gentlemen, that just spoke are telling you exactly what we're experiencing. I would say I'm personally seeing a ton of just resizing of projects, right? Because of the capital shift in the marketplace via, cost of capital and credit box constriction. I just feel that people are, as their loans become due and their project is not done, because also construction costs may have gone up, or they've missed the mark on timing, or there's a lot of variables in our style loans. But because the cost of capital changed and how secondary is looking at paper, people are forced to resize their projects, their opportunities, whether that's commercial, multifamily, residential. They're to some degree they're reshaping, and they're forced to bring in more equity at minimum. So even when we're originating paper, we're having a very common discussion of, listen, I know you're used to marketing material at 80-90% either LTV or loan to cost, but you're either bringing in the money now or you're bringing it in at the exit. And so as a lender, Futures Financial, we we really kind of, I don't want to say strong arm people to come in with the equity position at day one, but we direct them that way because we need to ensure our exit, kind of what Bill said. Like, so the exit is extremely, extremely a valid and intricate component of our underwrite at this point, whereas 3 years ago, people weren't looking at exit as hard because they were banking on the appreciation, right? And so I still think I'm probably one of the few that would say market for me as a whole is fairly stable, right? In terms of buying and we have the supply and demand issue, et cetera. So I don't see it depreciating, but I would tell you that the appreciation doesn't appear what it used to appear because not as many people can afford the price bracket that they were in 3 years ago. And so opportunity to me right now is repositioning and resizing of existing opportunities, which for the investors that were sitting on the sidelines when loans were falling from the sky or opportunities were falling from the sky, they just stacked liquidity and now are pouncing, and they don't have the problem coming in, you know, with 40% equity on a 60% debt stack, you know? So I really like I would just echo what Brock said in that I like the quality of institutional or seasoned borrowers that are now able to capitalize on the opportunity and we can finance them.
Yeah.
Go ahead.
Just to follow up for my originator friends here, I mean, what it does, this market really provides an opportunity for you guys to pick and choose all the quality deals. That's kind of that's what's so special, is that now you get to, you know, really only pick the cherries as opposed to fighting for deals. Now it hasn't, you know, you still have some of it still hasn't quite turned around because there's still a lot of operators out there, you know, trying to stay alive. But that's what I see as the future for both our sides of the market, whether you're on the non-QM origination side or on the buying of existing defaulted or troubled paper. On both, the opportunity set is only going to increase because, like we all know, the banks are out of the game, or they're at least backing down.
Yeah, and I think in the bridge space,
Sorry, really quick on Bill's note, you know, it all comes down to liquidity, right? I'm talking to you about a borrower needing to resize the actual hard asset or the project, which is the hard asset. Same goes to the banks who are forcing the hand of the operator or lender in resizing their book, right? So at COVID, it was margin calls. Basically, check yourself. You're over leveraged as a company, right? And we're calling you to the carpet because we're going to protect our interest as big bank lender or institutional lender. And now institutions are going, no, yes, warehouse lines are more available, but they are requiring a certain amount of give back from the operator. So I think Bill is going to become more and more opportunistic because the operators like the Brocks, myself, et cetera, are, if we're not liquid and don't maintain proper capital stack, leverage or debt and equity, then we too are forced out of the game or forced to make really hard decisions.
And you're going to see a lot of competition of Brock and Kendra go. Like, that's why I was glad to hear you only had 10 million, Brock. You're very conservative with your leverage. You know, it's a really smart approach. We've been the same way. I was brought up all equity. I'm just now starting to think about leverage just because I'm in a much better position. And I just, you know, but
we're going to keep it moving because we're actually going to touch on that 12-month outlook within our fields. So we touched on some negatives, we touched on tailwinds. What headwinds do you see coming down the pipeline, Kevin, that could potentially impact the performance of the loans you're originating or your active portfolio you're servicing?
I mean, we're always thinking about, you know, just economic pressure, economic tension, really what recessionary risks. And as we think about that, you know, in all the headlines, we hear a lot about this wall of maturities, which is been on the media quite a bit. And there's, I want to say, just shy of over 3 trillion in commercial real estate loans that are coming due over the next 4 years between now and 2028. And I can make the case that, really for commercial real estate, that there's kind of more of the tale of two cities where you have multifamily and you have industrial versus office and to some extent retail. But nonetheless, I mean, we're really unclear at this point on how that's going to get worked out. A lot of those properties may be underwater at those maturities, where, as kind of Kendra mentioned, there's going to be instead of a cash out, it'll be a cash in just to recapitalize those deals. And what that might mean for the markets, the public markets, and increasing volatility. And I could just reminisce around 2008, 2009, as the markets continued to decline, and markets fell and troughed, the public markets troughed around, I want to say March of 2009. But on the real estate side, it was a lag effect. Real estate prices continued to decline into 2010, 11. It wasn't until about 2012 when we kind of hit a trough there and started to recover. And what that might mean for this coming cycle, and pressures and tail risk of various property types. So those are some of the things we think about. We also think about, I would say, regulatory risk. Thinking about, I feel like every other week we're hearing about some new proposed bill around rent control or something else that might drastically impact our business, or with the influx of so much capital on the institutional side, and heightened awareness on the bridge lending space, does that bring in more regulation and oversight, where it's been to date more of the wild, wild west? So those are some of the things that kind of keep us up at night.
Brock. Yeah, the big things that keep me up are the regulatory issues that are going to happen. People don't understand how big this industry has gotten over the last 10 years. I mean, we're talking tens of billions of dollars in debt on the private side is being originated. I think one of the biggest competitors originated 500 million in short-term debt just last month. So it shows you how big this industry is getting. And then does it start to impact, and does it raise the eyebrows of the SEC, and how can it impact the general economy if you do start to see a significant increase in defaults within the private debt space? So what regulations is that going to start to attract? That's number one that we look at. But then also, being that we're a lender here in California, again, rent control, regulations around ADUs. I think was it Los Angeles that just overruled ADU requirements by local jurisdictions. So, how does that impact the lending that we're doing? So those are the two big main things, combined together is the regulatory issues. I think from a lending perspective, if you remain smart in your lending, you're making sure that the borrower's got equity in the transaction, that you have a clear exit strategy, your borrower is a confident borrower, I think you can really mitigate your risk, and you can get a really decent return in this marketplace as a fixed income investment.
Kendra.
I had a question.
Yeah.
So what, do you guys model towards a default rate? So like is there an assumed default rate of 1%, 3%, or
Yeah, good question. I don't have an answer to that. I mean, I always say, like, look, if you're sub 5% on default rate within the hard money space, I think you're probably doing pretty well in your general portfolio. So, but it depends on how much risk you're taking within your portfolio. Not every portfolio obviously is exactly the same.
And speaking to that, on modeling to that, for us, I could confidently say no. But we are not doing the highest leverage out there. I think more of the institutional lenders do, and that's where you see some of the leverage they're willing to grant. Whereas a firm such as myself or Kevin, we're back behind net worth individuals. We're treating every deal we're originating as if it's our own money going into it. So we're mitigating the risk. I'm not necessarily underwriting or forecasting out to a specific default rate.
Hey, can you guys talk about the regulatory environment? So one of the things that happened in 2008 was that a lot of hard money lenders moved into New York for GAAP or bridge lender, and they weren't able to foreclose on whatever buildings were going on, et cetera. Everything got stuck in New York court for years.
I actually have a question for Kendra on that.
Maybe
She doesn't know it. It wasn't.
I was hoping you guys could address that.
Set up
The regulatory legal environment.
So Kendra,
in case there is a default.
Yeah, so when we were talking on our planning call, I asked you, what markets are you avoiding altogether, your judicial versus non-judicial foreclosure states. Would you mind, I think that's where Marty's alluding to, would you mind explaining the differences between the two and what states are an absolute nightmare to foreclose in versus more favorable states, and what that means to the passive investor?
Well, I'm going to let Bill touch on a lot of that, not because I'm scared of the question, but because him and I linked arms in that space for many years, and he's laughing because he knows exactly why I stay out of those states. But it's much like Marty said, right? Judicial states, you're contingent on a judicial process, which it's not just as simple as the foreclosure process within the judicial system, because there's all kinds of delays within that in its own right. So if a borrower contests at all. Now, granted, we're not in the consumer space, so we're in a business purpose environment, which means all of our clients, at least at Futures, are entities, LLCs. They are not individuals and they're not trusts. That's how we operate. It still doesn't, it mitigates a portion of that, but because you don't have some of the RESPA and TRID overlays in the process, but you still are subject to the judicial process, which could be 5 to 10 years in New York. Someone could hold on to an asset without paying their debt for that amount of time. And that, I use New York, poor New York. New York gets a bad rap, but unfortunately, like my lost mit days, I have a little bit of like post-traumatic stress syndrome, right? But Bill's still living it. I don't know how he's doing it. But I would say to you, look, it really depends. I think so much of how we answer these questions as individuals comes down to how we've structured our business. And what I mean by that is how we've structured our capital. Because, you know, much like anything, it's so contingent on the expectation you set with your money first, right? So your credit box, if it's patient and or it's your own, then you're kind of, as long as you have the liquidity, you can do what you want and you can exercise some great opportunity, right? So I just think it's really comes down to, for us, there's enough business on the West Coast to avoid some of the landmines in sitting on capital, not moving capital. I mean, it's really that simple for us.
Mm-hmm. I mean, listen, if you're in the origination and lending game, and it's not really your business to default people out or foreclose on them, which is what, you know, I mean, our business is in making the profits between the discount we can buy defaulted debt for and what is owed or what the properties were. So it's a whole different game. But I would be the same way as Kendra. If I was on the origination side trying to do a multi-state strategy, maybe not cover the whole country, but, you know, the major states, I would stay out of judicial states as well. And just stay in, because your whole business is about originating loans, clipping the coupon, making the fees, originating new loans, not about loss mit and foreclosure. There might be non-QM shops out there where, like some of the folks asked, do you figure in, you know, default interest? I mean, there are guys that in my business that are buying commercial debt at par specifically to make money off the default interest. Some of them have actually had 60 Minutes episodes done about them in recent months. So there are different avenues. And so the answer is there's reasons to stay out of New York. I happen to know New York so well, and I like to get a few scars on my face. So it's more, you know, it's like blocking and tackling, and half my portfolio is in New York. Now, the reason it is that I bought the wounds of someone else. I took, you know, one of our other competitors out of New York because they got stuck in a situation where COVID hit. They were on the verge of foreclosing 7 years into foreclosures in New York City and Brooklyn. COVID hit, they shut everything down, and now they couldn't close their fund. Well, their problem became my win. And I got to buy late stage 7-year-old foreclosures for 43 cents on the dollar. So now I'm still fighting that battle, though. There's still, out of the 60 assets I bought in my first trade, you know, 2.5 years ago, that even some of those that were 7 years old or 5 years old, I still haven't finished. So there are, you know, it takes a different I guess, thickness to the skin to work in that market. But that's also where the opportunity set will be. I mean, New York City will never not be New York City. So I'm kind of licking my chops, waiting for for another, like an NYCB failure or, some other disruption in New York City to take advantage of. The issue is of headwinds, going back to the original question. You guys hit the nail on the head. You say regulation, I say direct government intervention. If I was lucky to not own a big portfolio in foreclosure at the time that COVID hit. But if I had, if something like that happened again and the government moratoriumed foreclosures, evictions, made it impossible for us to actually do our job, that's probably what keeps me up at night. And then the second thing that keeps me up at night is what we don't see. I think we didn't all see a liquidity freeze coming in the summer of 2008. And, the CLO and derivative market is like 10 times the size it was in 2008. So there's shit going on, excuse my French, that I have no clue. And private credit, to what you guys are saying, and which lacks a lot of transparency. Private credit is playing a large role in the derivatives market now. So who knows?
And we're going to keep it moving because we got about 10 minutes left. I want to make sure we're touching on some other important questions. We're going to pivot now to some vetting questions. I think a lot of these panels skip the vetting. Everyone does it. We have a great product. We look out for our investors. Their yield is secured against the asset themselves. But Brock, what are some vetting questions you would recommend a high net worth individual or a family office ask you, or a firm such as yours, before considering giving you an allocation? And how can they potentially independently verify some of your responses?
Yeah, so I would say that probably the number one question you want to look at, or what first right off the bat, is how that lender is built. I mean, what's their infrastructure? Who do they have running what? What systems do they have in place? I mean, it's the 3 Ps, the products, the people, and the processes. And you want to define that. And then once you've identified a number of originators or funds that you feel kind of meet your threshold, start to look at, where do you want to be lending? And you can be in California, the West Coast. Do you want to be nationwide? There's positives and negatives to both. In California, traditionally, returns have probably been a little less than maybe what you can see in other parts of the country. On the flip side, someone suggests that real estate in Southern California may be a little more sheltered from large variances in values. So, there's give and takes on both, and there's probably more opportunity in terms of pushing money out in some of these Southern California markets than other markets. So yeah, get comfortable with the 3 Ps and then what they're lending on, where and location.
Kendra. No comment. No, I'm just kidding. I think you're on mute still.
I wasn't coming off. That was weird. So, I think there's a lot to it, to be honest. A lot of what Brock said clearly. I feel like I'm stealing your rhymes here, Brock. Sorry. But
We've been in business together for a long time. So.
I think you need to look at who the founders are of any organization. Is it the leadership that you can trust with your money? Do they have similar philosophies as it pertains to risk and kind of the overall lens of which you see the world? I know that you don't have to get along with the CEOs of the stocks that you buy, but I'm saying to you, in this sector where it's private, I think it's important to understand the resume of these people so that you could understand what their bandwidth is. I think, I forgot who mentioned it, understanding if and when there will be leverage attached to your investment, how they are going to protect your investment. And what I mean by that is, are you as an investor isolated or fractionalized in your participation, so you're subject to performance? Or are you participating in a fund where performance is a little bit more, you have a little bit more of a buffer because it's blended with a portfolio of assets versus a single asset? is it a, you know, how does that return look overall? Are you participating in an upside, or is a preferred return that's paid every single month on time regardless? I mean, I think that, and then it's, like I said, it's everything that Brock said, like, what is their processes? What is their infrastructure? What does their capital stack outside of you look like? Can they weather a storm that, to Bill's point, we don't know anything about? I mean, we could all sit and listen to somebody tell us that they have a great prediction and they are notable in the space, but no one has a crystal ball, right? Elections are coming. Social environment is completely different than we've ever experienced. So how does this company weather those storms? I think that's a valid question today. And some of that isn't in an investor deck, if you will, or a PPM or a subscription agreement. It's, can you sit down with this person, have a cup of coffee, and talk about the good, ugly, and the indifferent? I think that's important.
I think it's delivery of the bad news. How does that work? And do you understand how, in a worst case scenario, how are we going to navigate this? No, Bill, what is a question you have never been asked by an investor that you think just about every investor should ask you before working with you?
Oh, man.
I did not put this one on the list, so I'm putting you on the spot.
Oh, wow. What's a question I've never been asked that I should have been asked? Oh, wow. That, I don't know if I should say that in public. No. I think I've been asked almost every question. The one question that I think that every investor should ask is, are you invested in the deals? And I am personally co-invested in every deal that we buy. So, you know, maybe only $1. No, I'm just kidding, but more than that. But, you know, but I put my money where my mouth is. And, you know, maybe that's not everybody's thing. And that's, but that's a question that if I think that everyone should ask. And I get it about a third, maybe 1/3 of the time or something like that, maybe less.
Right.
And everything else that these guys said is 100% on par. And what I want to point to is it's becoming known amongst the family offices that the managers, the $100 to $500 million managers, are the ones where they actually get alpha. And that's the group that's, you know, on this panel, that's in this room. People that aren't looking, I'm not looking to be, you know, well, a $5 billion or a $50 billion fund, because I think you lose integrity in terms of your responsibility to investors. And, you know, so there, you know, this group, you can hear by the fact that there's the diligent approach, the lack of leverage, the, you know, the smart, you know, they're putting, you know, the, just they're you know, they're not trying to do it all. They're picking their lanes. I think that says a lot about.
We just got a couple minutes left, so I'm gonna give Kevin real quick in 60 seconds, and then I got a quick rapid fire question for the group that will only take 60 seconds. So Kevin.
Sure, yeah, questions asked. Did that?
Yes.
I would say, you know, walk me through your 5 worst deals. You know, the fact is that we've been in a rising tide for well over 10 years in real estate. And a lot of the lenders today, ourselves included actually, and since we entered private lending, not real estate, but private lending, really haven't been tested with a true recession. You know, and so what in-house infrastructure do you have to deal with, or what bench of resources do you have to be able to tackle those? And do you have enough incentive to make sure you can continue protecting your investors as a fiduciary as things turn sideways in the market?
I like that. Now rapid fire, 12-month outlook. We're gonna start with you, Kevin, since you just answered that question last. Do you see more competition for loan originators in the private lending space in 12 months or less?
More competition until the recession hits and we'll go away.
Brock.
Good question. I would say there's going to be more competition, but I think it's going to be narrowly scoped. I think people are recognizing that you have to be really lending on a regional basis. Trying to do the shotgun approach of doing national is very difficult to manage well. So I think regional players are going to see more. There's going to be more competition within the regional players.
Kendra.
I rarely see competition because I seriously am hyper focused on what we do. And I'm not saying that from an arrogant spot. I just know what I do isn't necessarily what Brock does. And so not every client is my client. And we are scaling. So I just see an opportunistic market despite all the variables socially with the maturity walls. The bad deals against the good deals. I forget who said this at the beginning of the panel, but our phones are ringing like 10x, and we get to choose what clients we lend to. And we are highly selective in that lending process, and we do proper due diligence with the clients that we actually close. And our first objective is securing our investors' money and our own money for that matter, because we are an investor in our company. So I just see tons of opportunity for everybody on the panel, quite frankly.
Bill,
What separates the men from my father used to say, what separates the men from the boys is like anyone could make money in an up market. And what separates those from the real pros is when there's dislocation. So to your point, a lot of people haven't experienced that. And we've been on a 16-year run. And I predict a consolidation, because you're going to see a lot of operators, sponsors more than anything, go out of business, and the consolidation therefore.
I think I agree with you on that, Bill. And with that, I think that's a wrap, right on time. So if there's time for questions, Marty, we could take a couple questions. If not, we could keep it moving on.
I have to get started with the whole program, so it's pretty tough. I think some